On January 15th, 2026, something happened behind closed doors that should have rattled every American with money in a bank account. At a private banking conference, Brian Moynihan, the CEO of Bank of America, looked directly at a room full of institutional investors and delivered a warning that never made the evening news. He said that up to $6 trillion could leave the U.S. banking system within the next 36 months. $6 trillion. That wasn't a stress test. That wasn't a worst-case scenario. That was his baseline expectation. To put that into perspective, $6 trillion represents nearly 30% of all commercial bank deposits in the United States, and that money isn't expected to move to other banks. It's not flowing overseas. It's migrating to something that barely existed as a serious threat just 5 years ago: stablecoins. And the reason Moynihan is concerned, the reason major bank CEOs are quietly rewriting their deposit strategies right now, traces back to a single event that happened exactly 2 years earlier. January 10th, 2024. That was the day the Securities and Exchange Commission approved 11-spot Bitcoin ETFs, breaking more than a decade of regulatory resistance. And while several firms received approval, only one truly mattered: BlackRock. BlackRock's iShares Bitcoin Trust, ticker symbol IBIT, has now crossed $70 billion in assets. $70 billion in just 2 years. That is the fastest ETF to reach that scale in financial history. Faster than the SPDR Gold Trust. Faster than any major equity fund. Faster than anything Wall Street has ever seen. But here's the key point most people completely miss. The 70 billion isn't the story. The 70 billion is the proof of concept. What BlackRock demonstrated wasn't just demand for Bitcoin. It proved that institutional money, pension funds, endowments, insurance companies, and wealth managers controlling tens of trillions of dollars are now comfortable moving into digital assets when the infrastructure feels familiar, regulated, and safe. And once that barrier is crossed, once institutions understand how digital assets operate, how they deliver liquidity, efficiency, and yield that traditional banking simply cannot match, the next question becomes unavoidable. Why keep trillions of dollars parked in bank accounts earning near zero interest when stablecoins backed by U.S. Treasury bonds can generate 4 to 5% with instant liquidity? The answer is simple. You don't. And that single realization is what sets the stage for the largest deposit migration in modern financial history. This isn't theory. This isn't speculation. This is mathematical reality, and it's already unfolding while most people aren't paying attention. If you want to understand what's actually happening beneath the headlines and why this shift matters far more than Bitcoin's price, stay with me. Because to understand where this is going, we need to go back to the moment institutional crypto adoption truly became inevitable. The first day of trading, IBIT processed $627 million in volume. One day, that's more than most ETFs see in an entire month. By the end of the first week, it had crossed $1 billion in assets. By the end of the first month, $10 billion. By the end of the first year, $55 billion. The growth curve was exponential. As of January 22, 2026, IBIT holds $70 billion in Bitcoin. That makes it the 19th largest ETF in the United States by assets, ahead of funds that have existed for 20 years, the head of sector funds, international funds, bond funds. A 2-year-old Bitcoin fund is in the top 20 out of thousands of ETFs. But the assets under management don't tell the full story. Look at who's buying. Look at the actual investor base. According to public filings with the Securities and Exchange Commission, over 700 institutional investors now hold IBIT. State pension funds, university endowments, insurance companies, wealth management firms, corporate treasury departments. These aren't retail speculators buying through Robinhood. These are fiduciaries managing other people's retirement money, and they're allocating to Bitcoin through BlackRock's fund. Wisconsin's state pension fund holds $29 million in IBIT. Michigan's state pension, $95 million. The Arizona Public Safety Personnel Retirement System, $19 million. The state of Utah retirement systems hold positions. These are conservative institutions with strict fiduciary mandates, and they're putting police officer pensions and teacher retirement funds into Bitcoin. Why? Because the asset allocation models changed fundamentally after 15 years of zero interest rate policy. For decades, the standard portfolio was 60% stocks, 40% bonds. That worked when bonds paid 6 to 8% annually. Bonds provided income and stability. They balanced equity volatility. The 60-40 portfolio was the foundation of modern portfolio theory. But after 15 years of near zero interest rates following the 2008 financial crisis, bonds barely outpaced inflation. A 10-year Treasury bond yielding 2% when inflation is running at 3% means you're losing purchasing power. The 60-40 portfolio became obsolete. It didn't work anymore. So institutional investors started looking for alternatives. Real estate, but real estate is illiquid and requires active management. Private equity, but private equity has high fees and long lockup periods. Commodities, but commodities don't generate cash flow. And increasingly, they looked at Bitcoin not as a speculative trade, as a portfolio diversifier with low correlation to traditional assets. The data supported this. From 2013 to 2023, Bitcoin's correlation to the S&P 500 was near zero. Sometimes positive, sometimes negative, but always low. That means when stocks went up or down, Bitcoin often moved independently. That's exactly what you want from a portfolio diversifier. But institutional investors couldn't buy Bitcoin directly. Regulatory constraints prevented most pension funds and endowments from holding crypto on their balance sheets. Custody concerns made boards of directors nervous. Operational complexity meant hiring specialized staff. The barriers were too high. They needed a regulated vehicle, an ETF, something they could buy through their existing brokerage accounts with familiar custody and settlement. And once BlackRock provided that vehicle, once they removed the friction, the floodgates opened. In the first week of January 2026, IBIT saw 888.66 million in net inflows one week. 888 million, that's larger than most hedge fund launches. That's institutional money coming in after New Year portfolio rebalancing. Fund managers adjusting allocations for 2026, and they allocated heavily to Bitcoin exposure through BlackRock. At the same time, traditional banking deposits were declining. According to Federal Reserve data, commercial bank deposits fell by $212 billion in the fourth quarter of 2025. $212 billion. Where did that money go? Some went to money market funds chasing higher yields, some went to treasury bills directly, and an increasing amount went to crypto, not just Bitcoin, stablecoins, and that's where the real threat to banking begins. Most people don't understand how banking works at a fundamental level. They think banks are safe deposit boxes. You put money in, the bank holds it, you withdraw when needed. That's not remotely how it works. Banks operate on fractional reserve lending. And when you deposit $1,000, the bank is legally required to keep only a fraction in reserve. Under current Federal Reserve regulations, banks must maintain reserve ratios based on their deposit size. But practically speaking, most major banks keep around 10%. So when you deposit $1,000, the bank keeps $100 in reserve. The other $900 gets lent out immediately to someone buying a house, to a business expanding operations, to someone financing a car, to a corporation building a factory. The bank earns interest on those loans, typically 4 to 8% on mortgages, 6 to 12% on business loans, 10 to 20% on credit cards. That's how they make money, the spread between what they pay depositors and what they charge borrowers. The system works because not everyone withdraws their deposits simultaneously. On any given day, maybe 2 to 5% of depositors want cash. The bank keeps enough reserves to cover normal withdrawal patterns. The other 95 to 98% stays deployed in loans generating interest income. But what happens if that assumption breaks? What happens if 10 or 20% of depositors want their money at once? We saw this in March 2023 with Silicon Valley Bank. SVB held approximately $200 billion in deposits, most of it from technology companies, startups, and venture capital firms. Those deposits were invested in long-term treasury bonds and mortgage-backed securities purchased when interest rates were near zero. Then the Federal Reserve raised interest rates aggressively from 0 to 5% in 18 months. Bond values crashed. A bond paying 2% when market rates are 5% is worth much less than face value. SVB was sitting on massive unrealized losses, over $15 billion in paper losses on bonds they thought were safe. When depositors got nervous and started withdrawing money, SVB had to sell bonds to raise cash. They had to sell at huge losses, realizing paper losses into actual losses. The losses destroyed the bank's capital base. Within 48 hours, Silicon Valley Bank went from solvent and operating to bankrupt and seized by regulators. $142 billion in withdrawal requests in a single day. The bank couldn't meet them. It failed. The 16th largest bank in America collapsed in 2 days. That was one bank. Now imagine that dynamic playing out across the entire banking system, not because of a crisis, not because of panic, but because of yield competition, because customers realized they could earn dramatically higher returns elsewhere. Depositors don't all move at once, but over months the flow is steady and relentless. 3% of deposits in month 1, 5% in month 2, 7% in month 3, 10% in month 6. The numbers compound, the exodus accelerates. Banks start losing the cheapest source of funding they have, customer deposits. They have to replace that funding with more expensive wholesale borrowing from other banks or the Federal Reserve. Their net interest margins compress. The spread between what they earn on loans and what they pay for funding shrinks. Profitability falls. Stock prices decline. Credit ratings get downgraded. Borrowing costs increase further. A doom loop. And here's the killer detail that most people miss. The loans banks made don't disappear when deposits leave. If a bank lent $900 billion secured by customer deposits and those deposits leave, the bank still has $900 billion in loans on the books. Those loans mature over years or decades. A 30-year mortgage doesn't mature for 3 decades. But the deposits funding that mortgage can leave in minutes. a few clicks on a phone. The only way to replace deposits quickly is to borrow from other banks through the federal funds market or from the Federal Reserve discount window. But that borrowing is expensive, much more expensive than deposits. And if multiple banks are competing for the same wholesale funding simultaneously because they're all losing deposits to stable coins, rates spike dramatically. This is a liquidity crisis, not a solvency crisis. The banks aren't insolvent. They have assets, good assets, performing loans, treasury bonds, investment grade, corporate bonds. But those assets are illiquid. They can't be sold quickly without taking massive losses. And if the bank can't fund itself in the short term, it doesn't matter that the long-term assets are valuable. The bank fails before the assets mature. We've seen this movie before. 2008, Lehman Brothers, Bear Stearns, Washington Mutual, Wovia, banks with hundreds of billions in assets that collapsed in days or weeks because they couldn't fund themselves when confidence evaporated and wholesale funding markets froze. The difference between 2008 and what's coming is the trigger. In 2008, the crisis was triggered by bad assets, subprime mortgages defaulting, mortgage-backed securities becoming worthless, asset quality deterioration. This time, the assets are fine. United States government treasury bills, prime residential mortgages with borrowers who have excellent credit, investment-grade corporate bonds from blue-chip companies. The asset quality is not the problem. The problem is deposit flight driven by yield competition. And the trigger isn't crisis or panic. It's innovation. Better products, higher yields, more convenience. Stablecoins are simply better than bank deposits for many use cases, objectively better. And once that becomes widely understood, once the infrastructure makes them accessible to mainstream users, the shift accelerates exponentially. Banks understand this completely. That's why they're fighting regulatory approval of yield-bearing stablecoins. That's why banking industry lobby groups are pushing Congress to slow down crypto adoption. That's why Brian Moynihan is publicly warning about $6 trillion in potential outflows. He's not fear-mongering, he's stating mathematical reality based on yield differentials, but the momentum is already too strong. BlackRock's $70 billion Bitcoin ETF proved institutional demand exists. Circle's upcoming March initial public offering will prove stablecoin demand exists at scale. And once both are legitimized, once mainstream financial institutions are offering these products through familiar channels, the deposit flight begins in earnest, not as crisis, as rational consumer choice. Now let's talk about what BlackRock's is actually building, because the Bitcoin ETF isn't the endgame. It's phase one of a multi-phase strategy to dominate digital asset infrastructure. Larry Fink, BlackRock's CEO and founder, has been remarkably public about his views on crypto and blockchain technology since 2023. He called Bitcoin digital gold in multiple interviews. He said blockchain technology would fundamentally transform financial markets over the next decade. He predicted tokenization of real-world assets would be the next major wave of innovation in finance. These weren't offhand comments. These were strategic signals about where BlackRock's was heading. Tokenization means taking real-world assets like stocks, bonds, real estate, commodities, and representing ownership through digital tokens on a blockchain. Instead of holding a physical stock certificate or an entry in a centralized database, you hold a digital token that represents the same ownership rights, but with dramatically improved functionality. Why does tokenization matter? 3 reasons: speed, cost, and accessibility. Traditional security settlement takes 2 business days. You sell a stock on Monday, the transaction settles on Wednesday, and the money hits your account Wednesday afternoon. With tokenized assets, settlement is instant. Seconds you sell, you get paid, done. No waiting, no settlement risk, no counterparty exposure during the settlement window. Traditional securities have high transaction costs. Brokers charge commissions. Clearinghouses take fees. Custodians charge storage fees. Transfer agents process ownership changes. Every intermediary adds cost. Tokenized assets eliminate most intermediaries. Peer-to-peer transfers on a blockchain, direct ownership. Fees drop from dollars per transaction to pennies or less. Traditional securities have restricted access based on wealth and geography. Many investments require accredited investor status, net worth over $1 million, excluding primary residence, or annual income over $200,000. Minimum investments of $100,000 or more for private equity, hedge funds, real estate partnerships. Tokenized assets can be fractionalized. Own 1/10 of a commercial real estate property. Own 1 share of a private equity fund. Own 0.01 Bitcoin. Democratized access to previously exclusive investments. BlackRock's has been building this tokenization infrastructure quietly but systematically. In March 2024, they launched the BlackRock's USD Institutional Digital Liquidity Fund, ticker symbol BUIDL. It's a tokenized money market fund built on the Ethereum blockchain. Institutional investors buy tokens representing shares in the fund. The tokens are programmable, instantly, transferable globally 24/7 and can be used as collateral in decentralized finance applications. The fund invests in cash, treasury bills, and repurchase agreements. It yields approximately 5% annually, and it settles instantly. As of January 20th to 26, Budell holds over $700 million in assets, small by BlackRock KK's $10 trillion standard, but it's operational, functional, battle-tested, proving the model works at institutional scale. Now connect all the dots. BlackRock CK operates the largest Bitcoin ETF at $70 billion. They have tokenized money market funds operating on Ethereum blockchain. They have relationships with every major institutional investor in the world through their existing fund business. They have more assets under management than any competitor. And according to multiple industry sources that are applying for federal stablecoin licenses under the Genius Act. In December 2025, reports surfaced that BlackRock CK filed preliminary applications with the Office of the Controller of the Currency to operate a federally chartered stablecoin. BlackRock CK hasn't confirmed publicly, but multiple sources familiar with the application process say it's real and progressing. Imagine a BlackRock CK-issued stablecoin launching in late 2026 or early 2027, fully backed by United States Treasury bills held at regulated custodians yielding 4.5%, distributed to holders, available through every broker, every wealth manager, every financial advisor that already distributes BlackRock CK funds, which is basically everyone. Institutions trust BlackRock CK more than they trust Circle or Tether or any crypto-native company. If BlackRock CK offers a stable coin with institutional-grade custody, regulatory compliance, transparent auditing, and competitive yield, adoption will be massive and rapid. Pension funds can hold it, endowments can hold it, corporate treasuries can hold it, all with board approval and fiduciary comfort. That's the master plan. Bitcoin ETF proves crypto demand and generates $70 billion in assets. Tokenized funds prove blockchain infrastructure works. Stablecoin provides the on-ramp for trillions of dollars to enter the digital asset ecosystem. And once dollars are in the ecosystem, earning yield and operating on blockchain rails, they don't flow back to traditional banks. They stay digital, moving instantly, operating globally, outside the traditional banking system entirely. This is why BlackRock's $70 billion Bitcoin ETF matters so profoundly. Not because $70 billion is transformative by itself, but because it's the proof of concept that unlocks everything else. It proved institutional demand existed. It proved regulators would approve. It proved custody solutions worked. It proved the market had appetite. And now the infrastructure is being built systematically to capture the $6 trillion that Brian Moynihan sees leaving traditional banks. BlackRock CK isn't trying to build a crypto company. They're building the next generation of financial infrastructure, and they have the scale, trust, and distribution to actually pull it off where others have failed. Let me show you exactly what happened in January 2026, month by month, week by week. Because this month is when the tipping point became undeniable, when the trajectory became clear to anyone paying attention. Week 1, January 1st through 7th, BlackRock CK's Bitcoin ETF recorded $888.6 million in net inflows for the week. Not gross inflows, net inflows after redemptions. $888 million in a single week. That's institutional money flooding in after New Year rebalancing and portfolio reviews. Fund managers making allocation decisions for the year ahead. And they allocated heavily to Bitcoin exposure through the largest, most trusted name in asset management. For context, the average equity mutual fund sees inflows of 10 to 50 million per week. IBIT saw 888 million. The scale is different. The conviction is different. This is institutional adoption at a pace nobody predicted. Week 2, January 8th through 14th. On January 10th, the 2-year anniversary of Bitcoin ETF approval, financial media ran retrospectives, articles analyzing the impact, interviews with fund managers who allocated, success stories from early adopters, CNBC, Bloomberg, Wall Street Journal, all covering the milestone. This wave of positive press drove another surge of interest. IBIT saw 412 million in net inflows for the week. More importantly, competitor ETFs saw outflows. Money wasn't flowing into Bitcoin ETFs. Generally, money was concentrating into BlackRock CK. Specifically, investors want the largest, most liquid, most trusted option. Network effects and winner-take-most dynamics playing out in real time. Week 3, January 13th through 19th. On January 15th, Brian Moynihan gave his now famous speech at a closed-door banking conference in Florida. He warned attendees that $6 trillion in deposits could migrate to stablecoins over the next 36 months. He said banks must adapt or face existential pressure. The speech was supposed to be private. Someone leaked it. Within hours, it was all over financial media. Bank of America stock fell 3.2% in 2 trading days. JP Morgan fell 2.8%. Wells Fargo 2.4%. Regional banks fell even harder. The market started pricing in the stablecoin threat as real and material, not someday now. Week 4, January 20th through 26th. This is where we are currently. Multiple developments compressed into a single week. On January 22nd, BlackRock CK moved $430 million worth of Bitcoin and Ethereum from cold storage wallets to Coinbase Prime. The transaction was visible on public blockchain explorers because all blockchain transactions are transparent and traceable. Within minutes, crypto Twitter exploded with speculation. Was BlackRock CK selling? Were they exiting positions? Was this a bearish signal? The reality is mundane and operational. When ETF investors redeem shares of IBIT, BlackRock CK has to deliver them cash. To get cash, they sell Bitcoin. To sell Bitcoin, they transfer it from secure offline cold storage to Coinbase Exchange. These are routine redemption flows, not panic selling, not strategic positioning, just operational mechanics of running an ETF. But the fact that $430 million moved in a single day shows the scale of institutional activity. This is not retail traders moving thousands. This is institutions moving hundreds of millions daily as routine operations. The infrastructure is handling it. The liquidity is there. This is mature market behavior. On January 23rd, Circle formally announced their IPO roadshow would begin February 10th. The company is targeting a valuation between 12 and 15 billion. For context, that would make Circle more valuable than 85% of regional banks in America. A 6-year-old stablecoin company worth more than century-old institutions with branches, employees, legacy infrastructure. The symbolism is powerful. Traditional banking is literally being outvalued by digital alternatives. Markets are forward-looking. They see where things are going, and they're betting on stablecoins over banks. On January 24th, Fidelity announced their yield-bearing stablecoin would launch March 3rd, 2026. Initial distribution through Fidelity brokerage accounts only. 47 million Fidelity retail customers will have access. Instant, seamless, right in their existing accounts. No need to open crypto exchange accounts. No complicated wallet setups, just an option in their cash management menu. Hold dollars at 0% or hold stablecoins at 5%. The choice will be obvious. And on January 25th, Ripple received final regulatory approval for their federal stablecoin charter. That makes them the 5th approved issuer under the Genius Act framework. 5 federally regulated stablecoin providers launching operations in Q1 2026, all with the ability to pay competitive yields, all with institutional-grade compliance, all with mainstream distribution through traditional financial channels. This is the inflection point. This is when stablecoins transition from crypto-native tools to mainstream financial products, from niche to normal, from speculative to standard. And once that transition completes, the $6 trillion deposit shift accelerates from possibility to inevitability. Let me walk you through what happens over the next 12 months, not speculation, strategic projection based on current trajectories and historical adoption curves for financial technology, February through March 2026. Circle IPO happens in early March. Market reception is strong. The stock price is above the IPO price on day one, closes the first week up 20 to 30%. Financial media covers it extensively. CNBC brings on the CEO for multiple interviews. The narrative shifts from crypto being fringe and speculative to crypto being legitimate with publicly traded companies, audited financials, regulated operations. Fidelity launches their yield-bearing stablecoin on March 3rd as scheduled. Initial uptake is modest but meaningful. $2 billion in the first week, $5 billion in the first month. Conservative start, but momentum builds as word spreads among Fidelity's customer base. People start calculating the difference, 0% versus 5% on cash balances. The math is undeniable. April through June 2026. Other major financial institutions follow Fidelity's lead. Charles Schwab announces stablecoin integration in April. Vanguard, traditionally conservative, announces they're evaluating stablecoin money market alternatives in May. Lower capital costs, higher yields on cash reserves, instant settlement with global suppliers, automated treasury operations through programmable money. These efficiency gains compound. Early adopters win. Fifth, if you're young and early in your wealth-building journey, the financial system you'll interact with in 10 to 20 years will be fundamentally different from the system your parents used. Learning about digital assets, blockchain technology, decentralized finance, smart contracts, tokenization, these aren't optional curiosities. They're essential financial literacy for the coming decades, like learning to use the internet in 1995. Not everyone understood it then. Everyone uses it now. Digital assets are following the same adoption curve. Here's specifically what you should do. Start small. Open an account with a brokerage offering crypto exposure if you don't already have one. Allocate 1 to 5% of your investment portfolio to Bitcoin through ETFs like BlackRock's IBIT. Not because Bitcoin will definitely go up, but because portfolio theory suggests holding uncorrelated assets improves risk-adjusted returns over time. When yield-bearing stablecoins become available through your brokerage in Q1 2026, test them. Move a small amount, 1,000, 5,000. Understand how they work. See the yield accumulate. Verify you can move money in and out easily. Build confidence in the infrastructure before committing larger amounts. Don't overallocate to any single innovation. Don't bet your entire net worth on crypto. This isn't about speculation or getting rich quick. This is about adapting to structural change in the financial system the same way you adapted from cash to debit cards, from paper checks to online banking, from physical stock certificates to electronic brokerage accounts. Evolution, not revolution. Adaptation, not disruption. Stay informed about regulatory developments. This space moves faster than traditional finance. Regulations change, new products launch, companies merge or fail. What's true today might be different in 6 months. Follow primary sources. Read actual SEC filings, not just headlines. Understand the underlying mechanics, not just the marketing claims. And most importantly, ignore the extreme voices on both sides. Crypto has evangelists who claim it's the solution to every problem and will replace all traditional finance within 5 years. That's wrong. Crypto also has skeptics who claim it's entirely worthless and will collapse to zero. That's also wrong. The truth, as always, is in the middle. It's technology. Some applications will succeed massively, some will fail completely. Your job is to understand which is which through careful analysis, not emotional reactions. Let me bring this full circle and connect all the pieces we've covered. On January 15, 2026, Brian Moynihan warned that $6 trillion in deposits could leave the United States banking system over the next 3 years. On January 22, 2026, BlackRock's Bitcoin ETF held $70 billion in assets, exactly 2 years after launch. These aren't separate, unrelated stories. They're deeply connected parts of the same transformation. BlackRock's success with the Bitcoin ETF proved that institutional demand for crypto exposure is real, massive, and growing. That proof of concept opened the regulatory and institutional doors for everything that follows. Stablecoins, tokenized assets, blockchain infrastructure, yield-bearing digital dollars. Once that infrastructure is built and operational, once yield-bearing stablecoins are available through every major brokerage with familiar interfaces and regulatory protections, the $6 trillion deposit exodus that Moynihan warned about moves from theoretical possibility to mathematical inevitability. Not because banks are bad or failing, because innovation provided objectively better alternatives. Higher yields, lower fees, instant settlement, programmable money, 247 global access, better products win, markets decide, customers choose based on value. This is the biggest transformation in finance since the internet enabled online banking in the 1990s, possibly bigger. Because online banking changed the interface, the customer experience, the convenience. Blockchain changes the actual infrastructure, the rails, the settlement layer, the foundation. The banks that resist this change will slowly shrink into irrelevance. The banks that adapt and position themselves as infrastructure providers will survive and potentially thrive. The companies building the new infrastructure, the BlackRock's and Fidelities and Coinbases and Circles, they will capture enormous value as trillions of dollars migrate to digital rails. And the individuals who understand this shift early, who position themselves appropriately, who build skills in the emerging infrastructure, they will have significant advantages in the financial system of 2035 compared to those who ignore it. BlackRock's $70 billion Bitcoin ETF didn't directly trigger a banking panic, but it proved the concept that made everything else possible. It legitimized institutional crypto adoption. It demonstrated that trillions in institutional capital wanted digital asset exposure if given the right vehicles. And that legitimization enabled the stablecoin revolution, the tokenization wave, the $6 trillion deposit migration. It's all connected, all part of the same transformation. And it started with one ETF 2 years ago that most people dismissed as a niche product for speculators. If this analysis has been valuable, subscribe to this channel immediately. Hit the notification bell because the next 90 days will be critical. Circle's March IPO, Fidelity's March stablecoin launch, BlackRock's stablecoin charter approval, multiple catalysts converging in Q1 2026. The $70 billion proof of concept is complete and validated. The $6 trillion migration is beginning, and Wall Street's biggest structural shift since 2008 is happening right now in real time. The question isn't whether this happens. The question is whether you understand it early enough to position accordingly. Thanks for watching.